And ladies and gentlemen, welcome to the Dylan Hawley Experience. It is 7 p.m. Pacific Standard Time, 10 p.m. Eastern Standard Time for those in the New York or Eastern Time Zone. This is your midweek market recap. And let's just jump straight into it. Stock futures rise slightly as investors weigh cross currents of latest earnings reports. Stock futures ticked higher Wednesday night as investors responded to a weak outlook from retail chain Target, early in the day, and results from NVIDIA and Cisco that landed after the market closed. And we will be speaking further about NVIDIA's earnings reports just after this. Investors are also anticipating more than half a dozen speakers from the Federal Reserve talking at events around the country Thursday. Futures tied to the Dow Jones Industrial Average gained 50 points, or 0.2%, S&P 500 futures added 0.2%, while NASDAQ 100 futures rose 0.3%. Retailer Bath & Body Works jumped more than 20% Wednesday after it beat revenue expectations and doubled what was anticipated for per-share earnings. Cisco was up more than 3% after the bell, after beating both earnings and revenue estimates. The latest moves followed a down day on Wall Street, the second in 3 days. The S&P 500 and NASDAQ Composite fell 0.83% and 1.54% respectively. The Dow Jones Industrial Average lost 39.09 points, or 0.12%. Downward pressure, we just backed out of it, y'all, sorry. Downward pressure emerged from weak guidance from Target, which reported a decline in sales as inflation pinches shoppers heading into the holiday season. The Minneapolis-based chain ended 13% lower, while its forward guidance cast doubt on other retailers. And that is about where we will stop with this overview right here. Let's break down this NVIDIA earnings report. NVIDIA revenue falls 17%, but data center growth remains strong. So their earnings per share, they actually earned 58 cents per share versus the 69 cents expected. So it did fall short of earnings. And then they made $5.93 billion in revenue versus the $5.77 billion expected. So it did beat on earnings. But I guess everyone's valuing it down and as a negative thing because their earnings were lower than like what they actually wanted them to be, even though these estimates are showing that they beat them from this. It's weird. The analyst estimates, they always vary. So someone may have honestly gone off of one estimate for this headline and then actually showed it because they did beat on earnings here, or on revenue, fell short of earnings, but beat on revenue, but they're saying they did not beat on revenue here. Maybe they're talking about the revenue falling year over year, but that's a recession thing. Like, the fact that the revenue is only down like 17% is pretty good, especially in the tech sector. And, maybe it sounds like, oh, it's NVIDIA cope, it's semiconductor cope. But like, dude, if you're looking at the Meta revenue, dude, their revenues are down like 50%. Netflix, their revenue is stagnating. So again, I think this is just a product of NVIDIA being an overvalued company and it just hitting it significantly harder than most other companies. I mean, if you look at their valuations, it's basically down 60% from its all-time high. Obviously, it was down 60%. Now it's like 55%. So it has gone up 5%, granted, from its 2022 low. But it's just an overvalued company. I guess they do have a relatively large runway in terms of where they could grow their dividend in the future. But I don't think I personally am not investing into NVIDIA. I can't say, I think this is a buy or a sell. I just am personally, I think there are better companies that I believe I can invest into. And I'm going to continue to do that. Again, I'm not saying that this is a bad company, period. I just think it's overvalued by most market terms. Obviously, this is not financial advice. Anyone who is watching me knows that I'm not someone who gives stock picks. I'm not someone that does like trading or anything like that. I just invest. I tell you guys what I invest into. And I tell you just not necessarily where the market's going to go, but based off of different types of biases and what I see from these charts and instruments and these tools that I use, what could happen. It's not a definitive. So maybe NVIDIA does end up rebounding from this or goes even further. I don't know, man. That's that's what makes this investing thing so fun. No one has any idea. We just kind of send it and just pray for the best and hodl. But speaking of big tech companies and them not having the greatest week of all time, Amazon is reportedly has plans to lay off about $10,000 or 10,000 employees starting this week. So it's just the next in line for big tech layoffs. We had Meta's massive layoff event last week. So again, companies that are overvalued, bloated, and now the physics of like printing a bunch of money is catching up and locking up credit markets is catching up. So Amazon's starting to stagnate. Again, happens, dude. That's what happens when the market is overheated and is starting to cool down. Stuff stagnates, people get laid off. Obviously, to the 10,000 employees that did get laid off, I actually don't know. I am interested to see what the Amazon layoff or Amazon severance package 2022. Let's see, because that's the other big thing. So where the hell are they going to talk? I guess it hasn't been leaked out yet. I know that Meta's severance package got leaked out. So let's just take a look at that Meta severance package. Bada boom. Yeah. So it's actually it's a fairly good severance package. So people can see like, oh, the big tech companies are heartless. The corporations are heartless, and they probably are. But at least with these big tech companies, they do have a certain degree of money in the bank. So when they do give off those severance packages, they're going to be a little bougie. But it's pretty competitive. So 16 weeks of base pay plus 2 additional weeks for every year of service within the company, a payout for all remaining paid time off, RSU vesting through November 15th, 6 months of health insurance. Health insurance coverage for employees and their families, 3 months of career support with an external vendor, including early access to job leads and immigration support for workers here on a visa. So it is a pretty competitive severance package from Meta. Obviously, this one was leaked out. We don't know what the Amazon severance package is. And is this from their corporate side? So the cuts would be the largest in the company's history and would primarily impact Amazon's devices organization, so their Kindle teams mostly, and their Fire and Echo teams, retail division, and human resources, according to the report. Yeah, so it's going to be their hardware divisions, and that's the other big thing that we also need to take into context here. Like, yes, I guess on paper, a company laying off employees is not a great thing, but they're still keeping most of their warehouse force. It seems like these are mostly focused on their mature hardware division, which like everyone uses an Amazon Fire Stick now, or uses an Amazon Echo or a Kindle, and I think that their ecosystem is so mature, from like Amazon Prime to Prime Video to Audible and Amazon Kindle books and their Kindle bookstore and everything. And now I think they have like a book streaming service. So you pay like $10 a month and you can read any book. And I think they have like their Amazon Prime Music too. So these things are mature. And when they hired all of these people on, this is a big thing. And I can actually pull up like I think it's an innovation curve. I think that's the best way to do it. Innovation curve. Bada boom. I mean, this isn't really the one that I'm looking for. I mean, this could, let's just do, is it the law of diminishing return curve? I think that's probably what it is. It's the law of diminishing return. Oh, where the hell is it? Okay, I guess this one will do for the time being. But basically, at this point here, this would and this is talking about COVID, and like it's some COVID graph that they're talking about. But just get rid of like this headline thing and just look at the actual setup of it. So right here, we're looking at like a pre-Kindle Amazon. So they're still doing their Amazon Prime, and they're mostly a package courier company that sells stuff. It is an online marketplace. That and obviously that's still their bread and butter, but like that was all that they had. Then they had like a pretty massive shift where for a while they were putting a lot of resources into the Amazon Kindle and their Echo and their smart home compliance and appliances and everything like that. And this was this growth period right here. And that's basically where that was the paradigm that we were in technologically on all fronts, the market on all fronts. That was basically like the last like 10 to 15 years. It was basically the massive investment into R&D and then an overvaluation of that market as well that have been propagated by relatively loose credit markets. So if we run it back to Amazon, we take a look here, and it's basically them doing a massive investment into these product categories and service categories that are immature. Like they weren't there 10 or 15 years ago. And they already built that pretty robust and dynamic ecosystem where like there is definitely an Amazon ecosystem now. Like there are people who use Amazon Prime, who also use Amazon Music, who also have Kindles, who also use the Amazon Fire Stick and use Prime Video and have an Echo. Like they have carved out that part of their market. And because it's an immature and because it's now a mature product category, I don't think they need to innovate as much. Not to say that there's never going to be a next step for them to take. I'm not saying, and I think in 1899, we'll do the 1899 patent quote. And like this is not what I'm saying right here. It says, quote, everything that can be invented has been, was reportedly a brash statement made in 1899 by the then commissioner of the U.S. Patent and Trademark Office, one Charles H. I'm not saying that everything that can be invented has been invented. What I am saying is, at least right now, when a market is cooling off, you don't need a massive amount of R&D. Now is when you hunker down and, for lack of a better term, trim the fat off of a bloated corporation, lean it down, and make further investment, or just keep things that are profitable to your bottom line. And again, what Amazon did with their layoffs, they did not lose still. And obviously, Amazon Web Services is like a completely separate thing. I'm just talking about the online marketplace part of their company. And once again, they did not say that they were getting rid and laying off anyone from the Amazon Web Services team. But they're not getting rid of warehouse employees. They're not getting rid of drivers or anything like that. Like they're still keeping their most important people in their most important divisions. So again, 10,000 layoffs aren't great. And anyone who did lose a job, I wish you, and in these layoffs from either Amazon or Meta, I wish you the best of luck. I'm sure most of them are super talented. Like these people that got laid off, and in Meta's case, it was mostly coders and developers. So they, like, all of them are like out there, dude, with like a crazy knowledge base and probably a crazy amount of talent. Like if you get a job at Meta, and this is in their Reality Labs division, or even their algorithm for Facebook and Instagram, WhatsApp, any of their divisions, you have to be cream of the crop. So I'm sure it's a shame that super talented people did lose their jobs in this. It does suck. So best of luck to them. Hopefully Amazon and Meta can get to a point, or already at the point, that they don't have to lay off more people. And this is actually at every corporation in general. I hope that I hope more people don't get laid off. Whether or not that's actually going to happen, who knows? I think the market's kind of pricing in more layoffs happening, which sucks. But it's rough. Yeah. It's thankfully I haven't been laid off from my position from where I work. So I am thankful. But when talking about people who are just the impacts of what this most recent market trend, this, from like basically the last year since this new recession started, there have been some changes in consumer debts that have been pretty worrying. Household debt soars at fastest pace in 15 years as credit use surges, Fed report says. Households increased debt at the fastest pace in 15 years due to hefty increases in credit card usage and mortgage balances. The credit card balance collectively rose more than 15% from the same period in 2021, the largest annual jump in more than 20 years, according to the New York Fed. The increase stems from, quote, a combination of robust consumer demand and higher prices, a Fed official said. Households increased debt during the third quarter at the fastest pace in 15 years due to a hefty increase in credit card usage and mortgage balances, the Federal Reserve reported Tuesday. Bo said, how's it going, Dylan? Bo, I'm doing absolutely fantastic. Thank you. Tuning into the midweek market recap. It is always a splendid time when you are here. Right now, we're talking about household debt in America surging at its fastest pace in 15 years. And before we go any further, I absolutely love this, and it's crazy to me that the Fed is coming out with this, because Bank of America, let's take a look here. Yeah, Bank of America, this was like a month ago. This was 29 days ago. I remember covering this story. Bank of America CEO says latest spending and savings data show that the U.S. consumer is healthy. He said that a month ago, and then the Fed came out. Come on, man. Where is it? There we go. The Fed came out on Tuesday. The Fed came out on Tuesday and said that this is the most indebted America has ever been. Total debt jumped by $351 billion for the July to September period, the largest nominal quarterly increase since 2007, bringing the collective household IOU in the United States to a fresh record of $16.5 trillion. Americans have $16.5 trillion worth of debt. Ouch, it hurts to hear. Yeah, dude, it's fucking crazy. Like unprecedented, dude. The increase follows a $310 billion jump in the second quarter that represents a $1.27 trillion annual increase. So in the last year, we've added $1.27 trillion of debt to our balance sheet. The collective of America. Debt has surged over the past year due to inflation running near its highest pace in more than 40 years, and amid rising interest rates and strong consumer demand. The biggest contributors to that debt load came from mortgage balances, which rose $1 trillion from a year ago to $11.7 trillion, and credit card debt, which climbed to $930 billion, dude. Holy shit. That's crazy. And it's not just the fact that credit cards have near $1 trillion worth of balances on it in America. Let's take a look at the average credit card APR. All right, because this is the other thing. It's not just the fact that there's balances, but there's interest that's being accrued on top of that. So the average interest rate, let's just take a look. That's a big increase from the average APR for all accounts in the third quarter of 2022 was 16.27%. All right, so let's pull up the handy dandy calculator for the millions. We're doing some math, man. Okay, listen. I understand some of the hate that the public school system gets, but thank God they taught us multiplication, because this is what, and obviously they taught us that when we were 6 or 7, but still. This is some math in context. So $930 billion times an average APR of 16.27%. Let's pull up that percent button. Boom, there we go. Let's take a look and see just in interest, how much interest in credit card debt. Easily the off of like second to payday loans, basically credit cards are the highest APR credit instrument that you can have in America. So each year, Now, in this new paradigm that we are in, Americans are accruing $151 billion worth of just interest each year on their credit cards, dude. The credit card balance collectively rose more than 15% from the same period in 2021, the largest annual jump in more than 20 years, according to the New York Fed, which released the report. The increase, quote, towers over the last 18 years of data, quote, end quote, a group of Fed researchers said in a blog post on the central bank site. Quote, credit card, mortgage, and auto loan balances continued to increase in the third quarter of 2022, reflecting a combination of robust consumer demand and higher prices. However, new mortgage originations have slowed to pre-pandemic levels amid rising interest rates. Who would have thought? Doubling the interest rate in 1 year is going to slow down mortgages. Again, I think that's a good thing. Again, and this is something that I've spoken ad nauseum about, but it's a return to where basically the 30-year mean, a return to the average. New York Fed researchers attributed the credit card growth to, quote, very robust, end quote, consumption, rising prices, and consumers using substantial levels of savings that remain on accounts. Along with the rise in balances has come an increase in delinquencies. However, quote, delinquency rates are rising. They remain low by historical standards and suggest consumers are managing their finances through the period of increasing prices. Auto loan debt, while also only posting a slight increase on a quarterly basis, is up 5.6%, and auto loan balances edged to $1.52 trillion, and the student loan debt nudged lower to $1.57 trillion. And I have a sneaking suspicion it's because they allowed for the forgiveness. That's and this is what they're also saying here. Student loan debt is the lowest since the second quarter of 2021 amid an extended period of forbearance and the Biden administration's efforts to forgive some education loan debt. I think the big thing that's really crazy to me is the auto loans at $1.52 trillion. Basically, every like newer car is all financed. Like everything in America is financed, dude. It's payment plans. Like that's how they built this whole thing up, dude. It's just payment plans. And when we're taught, and I think at this point, like 16.5 trillion, I know, I was saying this before COVID. I was saying this during COVID. I'm saying it now. Like, America's over levered. Like, we don't have the energy anymore to keep infinitely growing and infinitely spending, especially when inflation, they're saying it's 7.7%. That's their CPI numbers. But when you look at the price of food is still up 12.4%. When you look at the price of gasoline and energy, it's still up 17.6%. So the stuff that people actually buy is up at least, any consumer staple is up at least 10%. And we still have, if we take a look, if we run it back a little bit, we still have the CEO of Bank of America a month ago saying that spending and savings data shows that the U.S. consumer is healthy. How do we reduce this? Just stop spending. Okay, well, it's interesting because when you take a look at debt, I think from a personal finance end, the just stop spending argument, when people are like, okay, how do I cut down on debt? How do I get rid of debt? Just cut out frivolous purchases. The thing with America is everyone wants to live frivolously. I want to live frivolously. Most people I know want to live frivolously. And that's just like a psychological thing. Like most people like having more convenience. And I think the ability to have things be convenient most of the time is frivolous. Like DoorDash is very frivolous. It's convenient to use DoorDash instead of go out and even drive to the fast food place. You're paying $10 extra just to have someone bring you the fast food. If you want to take it a step further, even getting fast food is frivolous. Getting fast food is a frivolous thing. So how about instead of, being frivolous 5 days a week, every single day you go buy lunch, you tone it back to like once a week, and then you just buy food from the grocery store. Like there, from a personal finance end, yes, stop spending as much to cut down on the credit card debt. But the big thing is, and this issue of the basically a debt-based system comes from the issue of having a fiat currency. Like they can just infinitely print money and then like have fractional reserve lending. Like, dude, fractional reserve lending, it's not some crazy shit. Hold up, we got to take a look at this, dude. For the millions, fractional reserve lending. If you take a look at fractional reserve lending, basically the idea is bada boom, bada bing. The bank, you give the bank money, and then the bank, it holds a small part of it as like basically being able to meet consumer demands and bank runs and stuff like that. And then the other part of it is they can loan it out or use it as investments and stuff like that. Like this is most financial institutions. And when you have even the financial institutions where people are supposed to be putting money there as like a safe thing, when they're also doing this and also like loaning out the money, obviously this is how this whole thing works, is having financial institutions basically be able to like loan money out to people, and then people take those loans and they, they have their credit scores, and like you try to pay it off so you don't owe the bank any money. But this is how a system gets over levered. This is how people get over levered. Like this is how people get stuck doing minimum payments and stuff like that. So like I think at this point now, and there's people who are trying to work towards this future. You can't really change the paradigm in any significant degree without like, getting rid of capitalism in America. And socialists want to see it get overturned and overthrown and stuff like that. But Again, I'm not here to say whether or not that would happen, or whether or not I would like that or not like that. But you would need a massive paradigm shift, and not just like a currency management and a money management level from the government and the Fed and all the major banks, but also you would need a change in consumer and consumer habits. And it's a psychological thing. Like people want to live beyond their means. And I think by living beyond their means, most of the time, it gets them over levered, and then they get stuck in this trap. Now, speaking of people who got over levered, and get into this trap, I think no better person no single person embodies that story, that idea better. And it's been coming out recently, is Sam Bankman-Fried, and there is some absolute crazy shit coming out today. Like it's an intern leaking out Sam Bankman-Fried, some DMs on Twitter. And let's just break this down, because this is pretty gnarly stuff, man. So this guy asked him, so the ethics stuff, is it mostly a front? Sam Bankman-Fried, let's do effective altruism. That was his whole thing. It's effective altruism. So the ethics stuff, mostly a front. People will like you if you win and hate you if you lose, and that's how it all really works. Yeah, I mean, that's not all of it, but it's a lot. The worst quadrant is sketchy plus lose. The best is win. Clean plus lose is bad but not terrible. So SBF here is he basically just said his whole philanthropic side of him and what he was trying to do was mostly a front. This gentleman said, "You were really good at talking about ethics for someone who kind of saw it all as a game with winners and losers." Yeah, I had to be. It's what reputations are made of to some extent. I feel bad for those who get fucked by it. By this dumb game we woke Westerners play where we say all the right shibboleths and so everyone likes us. Obviously, there's people who are saying that this could be fake and everything like that. Largest rug pull in U.S. history. Yeah, I like definitely. The wild thing about what happened was, like in the cryptocurrency sphere, there, even going back to like 2010 and 2011 and 12 and 13, there were exchanges that collapsed. And whether it be from, people just like, or devs just pulling the funds out, or they got over levered, like crypto exchanges have always collapsed. What makes the FTX collapse so crazy and a genuine, like true, real, long-lasting and enduring black eye on that asset class was the fact that FTX was considered a real financial institution, not just a crypto exchange, a financial institution that was registered and licensed to operate in the United States. That's the real thing. Like, that is the real black eye. Like, everyone who I know that has an eye that has some sort of exposure or some sort of understanding to cryptocurrencies, they are truly frightened by this, because what happened in this last market, in this last bull run with crypto from, like 2019, or I guess like 2020, like mid 2020 to November of 2021, so last year, what really caused that one was like a pretty significant mass adoption and like first massive step into cryptocurrencies. Obviously, most of that was just people buying Dogecoin and Shiba Inu. Like, I was having a lot of conversations about Dogecoin and Shiba Inu with people during the bull market, like just like people that I knew out and about. So I feel like that's not the greatest use case of the asset class. But there were also other financial instruments that were being used with crypto. BlockFi card being one. I know someone that they were using their BlockFi card, and then BlockFi has basically gone insolvent and paused withdrawals, and now they can't get their BlockFi Bitcoin, Bitcoin that they've accrued off of that exchange. It's just like they're just not doing it anymore. So when you have these institutions that go insolvent, that's not a good look. It's not a good look when like regular everyday people lose hundreds or even like thousands of dollars, and like these are people where the most people in the United States are renters, and the average net worth of a renter in the United States is $1,600. So when people lose $200 or $300, it may not seem like a big thing, but when it's happening to millions of people across America, and they lose $200 or $300, and their average net worth is $1,600. That's their average. That's the median. That's not even like most of them. That's like weighted by a higher, like people typically with means and everything and averages, typically the higher side of things and people with higher net worths typically offset the people who don't have a lot of money and don't have high net worths. So a majority of people are worth less than $1,600, and they've lost hundreds of dollars on Dogecoin and Shiba Inu. Obviously, doesn't sound like, oh, it's not that big of a deal, Dylan, but it's a big deal to them. And that was basically their first and only interaction with cryptocurrencies thus far. It was either Dogecoin collapsing 75%, 80%, using a cryptocurrency card and not be or just having a cryptocurrency exchange that they invest on go insolvent. They don't have their funds anymore. And these were regulated companies. These were regulated exchanges. These were institutions that people trusted. And they all went insolvent because they built back doors and then loaned themselves money to go trade on a market because they're all degens. And then they lost billions of dollars. So they created a coin and then used that and then used their own coin as collateral that they set the valuations to. And then they just loaned out even more money. It's a Ponzi scheme. It's like crypto can be used correctly. It's just most people use it as a Ponzi scheme. And like people can say like, oh well maybe all of crypto is scam. But I think it can be used. I think it can have a use case to it, man. Quick cash grab. Yeah, and like the socialists and the Marxists, they like to use that as the argument. It's like, capitalism moment. I guess like the issue is it is innovative technology. It is something that is groundbreaking. It is something like there are aspects of it that will be used in a mass market and most like everyday people. I think that there are certain aspects of cryptocurrencies and blockchain technology and even like proof of work and proof of stake ideals that will be as ubiquitous as the internet one day. Maybe not like the fucking dog coins or like your safe moons. It's dude, it's like burying money. Obviously most of that stuff is not going to catch on. The fact that Shiba Inu at one point had a higher market cap than Credit Suisse, which obviously Credit Suisse is a whole other story. But it's just a shame that these financial institutions really just used it, like you said, as a quick cash grab. Going on, oh yeah, and now they're just talking about him possibly being a sociopath. Never know, but yeah, like everything that SBF said, if this is confirmed him, and people are saying it is confirmed him, but other people are saying it's not confirmed him. It's just stunning, dude. Like more and more stuff is coming out of this SBF and FTX meltdown. Speaking of the crypto meltdown, and I was talking about institutions going insolvent, crypto lender BlockFi is reportedly preparing for a potential bankruptcy. So basically take my entire spiel of what I said about financial institutions and cryptocurrency exchanges being seen as financial institutions then going insolvent. Just copy paste that right onto there as my response to seeing this. Binance CEO CZ Binance did come out and say that crypto will be fine. So, even after all of this doom and gloom, a cryptocurrency he's saying will be fine and announces an industry recovery fund. What's really interesting about this and him saying the crypto industry will be fine. Obviously this is not financial advice. I'm not telling people to go out and buy. I'm not saying it's a good buy right here, pick some up. I will say I dollar cost average into Bitcoin. And I bought. I had, so all of these companies are bankrupt, are going bankrupt, so insolvents. Yeah, so when you're insolvent, the definition of insolvent, let's just pull that up. So insolvent, unable to pay debts owed. So yeah, basically they are going bankrupt. They don't have the money to cover their debts. They don't have the money to cover their yields they've been kicking out. They don't have the money to cover consumer deposits. So people who want to pull money off of their exchange, let's say they sold Bitcoin and they want to pull it off of their exchange, or they just want to move Bitcoin from one wallet to another wallet, from BlockFi to their own private wallet. They can't do that. They have no money. The crypto exchanges have no money. Now, saying that is wild. Do the companies spend the money? Basically, yeah. I mean, like if you look at FTX, basically what was going on with FTX, we can actually look at the timeline too. Yeah, we can just look at the FTX series of events. I covered this on the end of the week market recap last week, but yeah, let's take a look here. So they in turn cannot pay it back. Yeah, basically. So what had happened was, FTX, they had this money, and then there's basically FTX, which is the cryptocurrency exchange, which was owned by Sam Bankman-Fried. He is no longer the CEO. So Sam Bankman-Fried, SBF, owned the cryptocurrency exchange FTX. He also owned a sister company, and it was more of like a trading firm. So they would try to like time the market and take positions and the buy low, sell high type of thing. And what FTX would do, they were basically loaning the money that they had to the trading firm to go out and try to trade and make money and make that money back. So they started losing all the money. They started making bad trades. And then what they did, and this is where the real big no-no came in. FTX, they had those user funds. So the money that people deposited, their Bitcoin, their Ethereum, that they quote owned, that was quote theirs. They went in there and SBF built a back door to where no one could see him doing this, but he was able to do it. Basically take everyone's money and then also loan it out to that sister company called Alameda Research to go trade that money and make it back. Well, Alameda Research lost that money too. So now they have no money. The actual financial institution has no money because they've loaned it all out. Then Binance came out, which was a rival exchange. Now, I guess, like, basically the only exchange besides Coinbase that's worth a damn. And that actually is in some way or another financially healthy. Binance had that token called FTT token, and the FTT token was basically the exchange token of FTX. So it was essentially getting high on his supply. Generally, yeah. So he basically created this token, this new cryptocurrency, and then gave like value to that. And then obviously like the market value and people owning it too. But he created this new fake coin, or it's not a fake coin. It was a real coin, but then created more collateral with that. So like that's where the Ponzi scheme stuff comes in. And what's interesting with Binance is they also have their own coin called BNB, Binance Coin, and they're building more use case with that, but it is something definitely to look at. So basically Binance sold the FTX token, crashed the collateral of that, and then all this stuff started coming out. So generally, yeah, it was getting high on their own supply and basically just gambling the money that they had. Gambling the money that they had. And then they lost it all. But the Binance CEO, CZ Binance, said everything is going to be fine. And with all of this stuff happening, I bought Bitcoin. And Bitcoin, like, I truly, in terms of just straight Bitcoin, I do believe that Bitcoin is not dead. I think a lot of the other crypto industry may be dead. I think there are a lot of projects and people that got burned that, you know, I don't know if a lot of people are going to come back to Dogecoin. They honestly might. You really never know. It's a fucking meme. It is the meme coin. It is the enduring meme coin. But a lot of people got burned, but I don't like, I'm not saying Bitcoin is not going to go down any further. I'm just saying, regardless of the price action of Bitcoin, I myself will continue to dollar cost average into it. I'm not saying anyone else should. I'm not saying that anyone else will make money doing that. What I am saying is I believe Bitcoin is valuable to me. I believe Bitcoin is undervalued to me. So I will invest into Bitcoin. Same way I will invest still into Ethereum. Still, even after all of this meltdown, Solana. I'm not advising anyone else invest into Bitcoin, Ethereum, or Solana. It's just my personal decisions. I will still be investing into the S&P 500 and some single stocks as well. Again, none of these picks I'm saying you should. I'm just saying that I do have and will continue to have exposure into utility companies, gasoline companies, PepsiCo, Coca-Cola, Altria. But I'm not saying anyone should own those. However, I do believe that the crypto industry will be fine overall. And I do think this industry recovery fund is good. So CZ Binance coming in and bailing them all out, dude. This is what SPF was actually doing too to some other companies earlier this year, and now FTX will not be getting bailed out. And he is saying that CZ Binance wants to form an organization that could, quote, establish best practices across the industry, which is known for its lack of regulation. And again, I think having regulation in these industries are good. There is a pretty significant amount of regulation with crypto industry and crypto exchanges already. The thing is actually making sure those guidelines are followed. And obviously those guidelines weren't getting followed. And like there are things to like there are already guidelines for companies to not commit tax fraud and accounting fraud. Now, companies can still do fraud. And when those companies are caught, they are typically prosecuted. And I think there's already that regulatory framework there, and I think it only gets further emboldened, and I think it only gets more strict. And frankly, when the securities, which is mostly what cryptocurrencies are, there are some commodities in there, but they are mostly securities, unregistered securities, at least in the United States, for like a broad amount of cryptocurrencies. Having more regulation in the securities industry is good. I don't care what anyone says. I don't care what any like hardcore crypto people say. Having regulation in the industry will protect people from getting hurt. Will protect people from losing 80% of their net worth on a dog coin. That's what I think is going to come of new sweeping regulation. And I do think overall the market's going to be okay. I think over time the market's going to be okay. Now, this, I think, arguably may be the biggest story of the week, in my opinion. And speaking about the markets possibly being okay, there is an independent variable upon which all other variables depend upon in the United States, if not on planet Earth. And that, according to mainstream media at least, is Donald Trump. And Donald Trump, to end off the midweek market recap this week, I'm sure everyone's already seen it, but it's just worth addressing. Former President Donald Trump is officially running in 2024 for President of the United States. Is this good for America? I don't know, but it should be fun. And I think on that note, we're going to end off the midweek market recap. Thank you very much for watching. If you haven't already, be sure to follow and subscribe on all my socials: Twitter, TikTok, YouTube, Twitch, everything's linked. Just go click them all, and then you can see what's going on. Twitter.com@RealDylanHoly, YouTube.com/@DylanHoly, Twitch.tv/RealDMH, and TikTok @DylanHoly. Thank you very much for watching the midweek market recap. It's much appreciated, and I will see you for your end of the week market recap. I hope you all have a fantastic evening.